It's yet another episode of Africa Business Weekly exclusively on CNBC Africa. Now this week promises to be exciting as we gauge stories that directly impact the sub-Saharan Africa business landscape. I'm Makion Bakeye. In the next half an hour, we'll bring you key interviews from the World Bank IMF spring meetings in Washington, D.C., as well as some acquisitions and investment. Let's start off from Southern Africa, where Palesa is on standby to take us through stories that shaped headlines this week.
Ahead of the 2023 spring meetings, the Evolution Roadmap proved its role in supporting the global economy amid current economic headwinds and uncertainties. My colleague Godfrey Mutizwa caught up with Sergio Pimenta, Regional Vice President for Africa at the International Finance Corporation, to establish the private sector's role in the development agenda. Let's take a look.
So on the green finance, I think it's very important that we keep in mind that Africa, on the one hand, is the continent that's contributed the least to climate change in terms of negative impact, but at the same time, that is the most impacted by the consequences. So out of that, we do need to take action, and particularly when it comes to adaptation. And we've done some studies in terms of assessing what are the needs, and we believe that there's opportunities to invest over $100 billion between now and 2040 to help the continent adapt to climate change. And one large part of this is what you were mentioning, which is the access to power. At the same time, we're all talking about having a greener sources of energy, and Africa still needs access to electricity, access to energy in many places. So when we do these efforts to increase access to energy, we need to do it in a way that is also leveraging what is available in terms of new technologies, in terms of green energies, renewable energies. And that's very much the approach that we've taken in Africa. We have been supporting a number of companies across the continent to make sure that they not only generate more electricity, but that there's distribution, there's the last mile. We have to look at the entire distribution system so that every household, every company in Africa has access to energy as quickly as possible.
Yeah, and I wanted to talk about that and how it connects to the private sector, because I know, of course, about your other work, which it does not attract headlines, i.e. The dirty work in terms of helping countries, helping governments create a better environment for the private sector to thrive in. But I wanted to talk to you a little bit more about how this increased financing that you're talking about, the 100 billion that you're talking about, is going to impact the private sector. Is that through direct investments? Is that partnerships? How will that work?
So the 100 billion is the opportunities that we see that needed to be financed. And when we look at the financial situation, the fiscal situation of many, if not all the countries in Africa, like in many other regions, it's very difficult to expect that the governments will be able to invest all this amount of money by themselves. It's very large sums. So this is why private sector has to come in and really fund a large part of it. So we see a large part of this $100 billion dollars to be financed by private sector, and that's where IFC also comes in. We want to support these companies, both international, local companies, regional companies, to seize the opportunities and to invest in adaptation, and that's what we are working on. And I fully agree, Godfrey, that this is, for us, the fundamental part that needs to be enhanced going forward, is that private sector will be the ones who will be able to finance a very large part of this investment. And then that's why we work on business environment, right? So that we can improve the business environment to make it easier for private sector investors to come in and support this type of development agenda.
The International Monetary Fund released its weakest global growth expectations for the medium term in more than 30 years. Earlier this week, it said that 5 years from now, global growth is expected to be around 3%. Our team stationed at this year's spring meetings in Washington, D.C. caught up with Pierre-Olivier Gorenges, who is the chief economist at the IMF. For more, let's watch.
So growth is still slow. It's actually going to be slower this year than last year, and it's going to be increasing. And inflation is going to be coming down. That's sort of the broad picture globally. Now, when we look at emerging market space, in many areas, many places in the world, they've already turned the corner. That's especially true when we look at developing Asia. So developing Asia is already growing quite strongly. That's the reopening of China. India we've revised down India a little bit, but it's still growing at 5.9%. It's still very, very high growth rate. And so parts of the emerging world, especially emerging Asia, are growing quite strongly.
Yeah.
When we look at other parts of the emerging space, and when we look at low income and developing countries, the picture is a little bit darker.
And that's where Africa would fit.
Parts of Africa, yes. And so here, when we look there, what we find is there is significant growth in the order of about 5% and around there. But when we adjust for population growth and we look at growth in income per capita, in fact, it's relatively low. It's only 2.8%. And 2.8% is less than what we expect middle-income countries to grow at, about 3.2 in the next 2 years.
Yeah.
So in a sense, the gap is going to widen a little bit, and there will not be much convergence for low-income countries towards middle-income countries.
Yeah, so that's the picture on the growth front. Let's talk about the inflation side of it. Your messaging has been very consistent. We need to fight inflation. A complicated equation when you look at emerging markets, because not only are we now fighting inflation, but we're also fighting slowing growth. But first, let's talk the inflation picture, in particular also as it pertains to emerging markets.
Well, so inflation is expected to come down, but emerging markets have also been hit very strongly by the rise in energy prices and food prices. This is particularly true when you look at the sub-Saharan Africa, for instance. Sub-Saharan Africa, we still have double-digit inflation. We had double-digit inflation last year. We will still have double-digit inflation next year and the year after that, even though it's gradually coming down. And that, a lot of that is reflecting the massive increase in energy and food prices we've seen in the last year. Some of it is coming down, but not enough. So you're absolutely right. It's an environment in which growth is not supercharged, and there is still inflation, and that inflation needs to be taken care of.
Yeah. Are we therefore, as a market, perhaps heading for stagflation? In which case, I'm then going to ask you, what would your policy advice be? Number one, in fighting inflation. Number two, trying to get growth going.
But for a lot of countries, fighting inflation means having a credible nominal anchor, so having a monetary policy framework that will allow expectations of inflation to remain quite stable, have a policy framework that goes around that. And a number of countries, including in the emerging space, are doing that, and they've improved tremendously around that. So a lot of emerging market economies had in fact started tightening monetary policy even before more advanced economies, because they were responding to the inflation pressures they were facing. And we see signs, for instance, when you look in Latin America or you look in other parts of the world, we see signs that their inflation process is coming gradually under control. So that is absolutely needed to bring inflation down.
That's it from me. It's back to you.
Thanks, Balesa. Let's now link up with Sarah to keep up abreast of happenings in East Africa.
Well, thank you, Akin. Listed lender I&M Bank Group is betting big on its new acquisition in Uganda to deliver further growth as the bank continues with investments in her regional subsidiaries. CNBC Africa had an in-depth interview with the bank's group CEO on prospects of the banking business in the region.
The year past has indeed been a good one for I&M. We posted strong results across the group. And with one of our subsidiaries, I&M Uganda, posting its first profit in full year results that we published for the first time within the group. Across the group, we have seen the business withstand some strong headwinds that we saw in all our markets, of course, driven by geopolitical issues that buffeted the markets last year. So to post a 34% increase in profits year on year is a good result. And at 15 billion shillings in profits before tax and just about 11.2 billion shillings profits after tax, so that's a strong result. So what would we attribute this to? Our strategy, Imara, which is in its second phase, so it's called Imara 2.0, has really driven digitization at the core and has helped us with driving penetration of customer centricity. So we've seen greater adoption of digital channels, and that has driven good balance sheet growth. Our deposits grew 3% across the group year on year, but the mix of deposits was weighted towards CASA or current accounts and savings accounts growth. at about 48%, which is very strong, given the journey we've been on digitization. We've also seen strong loan book growth at 13%. In our home market in Kenya, that was even stronger at 14%, which actually beat industry loan growth rates. We've also, of course, been pinning our service excellence on digitization. We've improved our customer value propositions across the group, and this has helped with greater customer loyalty and driven the results that you've seen.
Quite some commendable numbers there, Mr. Kihara. And looking at the big picture, perhaps talk to us about issues touching on the cost containment. We did see operating expenses also tinker upwards. And how would you equate this to the performance on the bottom line of the business?
Yes, indeed, we have seen our costs grow across the group. We've been, as expected, making investments to support our Imara strategy. So if we start with the investments that we've made over the past couple of years on our digital platforms, on the card management systems, which helped with really enriching our customer value propositions. This is expected, of course, to impact our cost line. And as these come on stream, we then start capturing them in the depreciation of our different assets. But at the same time, we've also been investing in our people.
Uganda, your latest acquisition, how do you feel about that market, speaking from a group perspective? I do know that Rwanda, a subsidiary, also did perform pretty well. And from the bigger scheme of things, how crucial is the Ugandan market for the bank? Are we likely to see more investments going that route? Well,
so Uganda has always been a key market, the target market for us. Not surprisingly, because as a Kenyan outbound business, we recognize that a lot of trade takes place on the Kenya-Uganda corridor. We are one of the routes to the sea, and a lot of our customers also invest in Uganda. So we made that acquisition understanding the strategic importance that the Uganda market has for our clients here in Kenya.
With the recent outbreak of the Marburg virus in Tanzania, the government of Zanzibar has moved to assure both regional and international travelers that the island is safe and open for business. Earlier, we were joined by the Minister of Tourism and Heritage in Zanzibar, Honorable Simai Mohammed Said, for more.
If we have to look in terms of numbers, Zanzibar has surpassed the numbers that we had prior before the pandemic had started, that is 2019. We were already on 500,000 visitors from 2019, and by 2020, we were just halfway by 250 to 260,000 people during the coronavirus. And look at it now, 2022, our numbers are already way above 500,000, and we are looking at to reach our target by 2025 of just below 1 million, which is we are heading towards the right direction. And I think one of the great reasons is that helped us was we were able to communicate with the world, but we also took a choice and decision as a country during pandemic to stay open, but following, of course, adhering by the WHO standards, but trying to cope and to understand that the importance of the industry and being alive, watching and communicating with the rest of the world. So Zanzibar, we were very fortunate, and that helped us to boost and promote the islands. So we are back.
Yeah, bouncing back, and the industry is definitely faring well. There are also fears of the Marburg outbreak that are circulating. What is being done to ensure safety of travelers?
First of all, let me first of all try and assure the rest of the world, and of course, people from all over the African continent. Tanzania, first as a country, we are as big as, if you take Uganda, Kenya, Rwanda, and Burundi, put them together, we'll still have another small country left. The Marburg virus was discovered out in the northwestern parts of Tanzania and Kagera. And currently, we are dealing with 2 remaining cases. The third person has been discharged from where quarantine place it was. And we are waiting for the two people to undergo the WHO standards of 21 days under lockdown and observation, of course. And I believe they are doing much better than how they were before. We've not had a single case on the East African coast, I mean, from Dar es Salaam, Tanga, and Zanzibar. And bear in mind, Zanzibar is almost 1,500 kilometers away, covered from land and water by the Indian Ocean. So we are very much would like to assure the rest of the world that Tanzania, along with Zanzibar, we shall be free from this the outbreak that has taken place on the northwestern region of Tanzania. And I'm confidently saying this because there has not been any other reported cases, and this was spoken by the Minister of Health of Tanzania, Honorable Umi, and also Tanzania. We are working with our developing partners and following the WHO standards. So we have deployed a rapid response team there, and we're keeping a close eye. So confidently, I can assure travelers, visitors, those who are traveling for business and visiting and holidaying in Tanzania and Zanzibar, we have nothing to worry for now. We are safe from the outbreak. And that's a big thank you to our developing partners and the Ministry of Health of the United Republic of Tanzania.
And that's all coming in from East Africa this week, Akin. What's playing out in West Africa?
Thanks a lot, Sarah. Now, the market was inundated with news filtering from sources that Nigerian billionaire investor Femi Adesina is now the second largest shareholder of listed diversified conglomerate Transcorp PLC after acquiring a 5.5% stake in the company. However, in a reaction, Transcorp says it is yet to receive any formal notification of any relevant interest in its shares. Femi Adesina, partner at Argentine Partners, examined the prospect of such an acquisition. Take a listen.
I guess one of the things Mr. Adesina has shown of recent is that he's quite agnostic and he's quite, he focuses on the money. And I think that's very important for everyone who's an investor. No emotions when he looks at companies who have the strategy and probably track record of delivering numbers. As an investor, in reality, you should be agnostic. And he's done that with First Bank, acquiring just slightly over 5% of the company. And he's doing that again with Transcorp. Now, something that's very interesting about his investment decisions is that it doesn't go into any of these companies seeking control or trying to take over management or create any boardroom squabbles. He's focused simply on protecting the wealth that he's acquired thus far and diversifying the family portfolio. And I think that if you were to advise any investor, especially HNIs who are looking at the long-term play for Nigeria and where they should be putting their investments. Obviously, Mr. Adesina is a leading light in that regard. Just telling us that we should be focused on value rather than making emotional decisions when it comes to investments.
All right, let's look at this. What is the sector where this business is looking at? One of the core areas is power and energy. We've also seen Adesina invest as well recently, and also list one other company, Kirikou, on the stock exchange recently. And it speaks to that the shift in mindset to the power sector. We're seeing a player list on the stock exchange. We're also seeing this move here by a player. More recently, we've seen moves by the president to allow states to have more control on how they address power. Do you think this could be some of the reasons why you're looking at we could have a brighter future for the power industry, and he's looking at how it could latch in there?
Look, I mean, without a doubt, Ken, I mean, the truth is that despite the challenges that power industry has had of recent, the reality is that the regulatory framework and the environment is beginning to become clearer, is beginning to become more positive. And we expect that the incoming government would hopefully continue with creating policies that continue to encourage private sector investment in that space. The truth is that, Ken, look, for a country like Nigeria, developing country, been hoping to break out of this third world cycle, not being able to grow our power generation past the 5,000 megawatt band. Every policy that encourages long-term investment in the industry is positive for the economy. And I think that if you look at the way Mr. Tedola has rearranged his portfolio, moving out of the downstream distribution space completely and effectively pitching his investment thesis around the financial services sector and the power generation sector. And well, maybe if you look at Transcorp's expanded portfolio, you'd say he's also diversifying his investment play. So look, power is a big thing. We've always believed that it's one of the biggest catalysts of Nigeria's next growth frontier. And investors who are able to play in that space, also with an understanding of the environmental framework and the strategy that's required for you to dominate, then it's going to be good. It's actually good news for the market.
Meanwhile, Ghana is targeting a 3.96 billion cedis in additional revenue this year, thanks to the recently passed new tax bills, which have been described as a key requirement for the International Monetary Fund to approve a $3 billion bailout. Kwame Ampofo, tax advisory consultant and managing partner, Lima Partners, a collaborating firm with Anderson Global, examined the country's drive for more revenue.
The basic reason for the introduction of these new taxes is to help meet IMF conditionalities. And basically, if you've been following news in Ghana, the IMF has made it quite clear Ghana's role in the negotiations is to try cut down on its expenses and then also find ways to raise revenue. Now, to cut expenses and particularly on finance cost for government, Ghana embarked on a debt exchange program late last year, which was implemented effective February this year, which was taken up by 80% of bond subscribers. I mean, effectively, the debt restructuring or the debt exchange program delayed or is going to delay the repayment of the payment of coupons on bonds. Now, following the after this particular bond restructuring program, the government has introduced some other taxes, some of them, of course, introduced through the reading of the budget for government business for this year. Some were immediately implemented sometime in January, and this included an increment of VAT from 12.5 to 15, bringing effective VAT rate in Ghana to 21.9. And then also the removal of or the reduction of e-levy, which is an electronic, a tax on electronic services or electronic money transfer, reduced from 1.5 to 1%. And then following those changes, just a few days ago, government introduced also based on proposals made in the budget for 2023, has introduced 3 more new taxes. They are effectively more than three more taxes because first, the changes cover income tax amendments, which affect about 8 different taxes. And then there's also the introduction of the Growth and Sustainability Bill, or the Growth and Sustainability Levy, which replaces the what we had as the National Fiscal Stability Levy, which was a 5% flat rate for certain category of companies. But this time, the Growth and Sustainability Levy is being structured to capture almost all companies.
Yeah, but Kwame, do you think these taxes will have the type of impact that the government is looking to achieve?
So if you follow what happened with the introduction of the e-levy, which was supposed to have generated so much revenue in Ghana, I mean, upon the introduction of the e-levy, the taxpayers started avoiding the use of products that would result in the payment of e-levies, and which resulted in government not meeting its tax revenue targets. Now, particularly because these new taxes are targeted at corporations or companies, and I mean, if you look at the growth and sustainability levy, if you look at one category of the taxes that's been introduced, that's going to affect mining and oil and gas companies, which are very, very profitable in Ghana. I doubt if there's any way these mining companies can avoid these taxes, particularly when it is targeted at their gross revenues. So this particular one is targeting 1% of gross revenues of mining and oil and gas companies, which is going to be quite difficult for any of these companies to avoid. So I think that, I mean, these new taxes are quite steep, but it's going to be pretty difficult to, I think the government is going to be able to achieve its targets. I doubt if it will be able to achieve the 4 billion cedis target set.
That's all we can accommodate in this week's episode of Africa Business Weekly. Many thanks to Sarah and Palesa for the regional update. We'll be back same time next week for more business stories across sub-Saharan Africa. I'm Akion Bakeye. Thank you for watching.